Hi everyone, this is Aleena Kareem. I am your expert tutor for the FR exam, which is a financial reporting exam of your ACCA stream. Today in this session, we are going to discuss a very important area, which is definitely going to be there in your exam, and that is related to the accounting for non-controlling interest. We emphasize a lot on the importance of controlling interest. Meanwhile, non-controlling interest is also equally important. So in today's lecture, we are going to have an overview of what NCI is, how it is recognized in different financial statements, and when the subsidiary is ultimately disposed of, then what do we do with it? So let's start with the discussion. Just a quick disclaimer that this is not a complete teaching video. This is a topic explainer video in which I'm going to discuss the overview of the complete topic. I won't be able to do a complete debrief, but I will try to touch upon all the topics conceptually which are related to non-controlling interest. So let's start with it. First of all, over here, this is the definition of the non-controlling interest: the equity in a subsidiary which is not attributable directly or indirectly to a parent. So whenever the consolidation happens, we have a parent company which goes and obtains control over the subsidiary company, as you can see on the screen also. Control is a very important word over here. So when one company obtains control over another company, which can be in the form of percentage of shareholding or any other contractual arrangement. But ultimately, if the control exists, then the investee becomes the subsidiary of the investor company. However, control may be obtained by having 50% or greater percentage of shareholding in the investee company. But what about if parent company has only, let's say, 80% share in the subsidiary company? There are still 20% shares which are out there, which belong to the shareholders, which do not belong to the parent company. And that is precisely the non-controlling interest. So the controlling interest is the one in which parent has the control over the subsidiary company, and non-controlling interest is the portion where the shareholding is with the remaining other shareholders. So over here, as you can see, combined parent and subsidiary, they form a group, which is based on the concept of substance over form. However, in the subsidiary company, there is a chunk which is related to the people or the shareholders who do not have control over the subsidiary company. But still, we need to account for them. They have a portion in equity. So we need to do the reporting for them also. When we are doing financial reporting, we are keeping in mind all the stakeholders and not just the party which is controlling the subsidiary. And that is what we are going to focus on today. So starting off with the measurement of non-controlling interest, or as we call it, NCI shortly. So there are two main models under which the NCI can be recorded. One is called the fair value method. The other is called proportionate share of net assets method. We are going to discuss both today in this topic explainer video. So starting off with how NCI can be measured in the financial statements, we first need to know that there are two models under which NCI can be measured. NCI is the abbreviation of non-controlling interest, a very frequently used abbreviation. So the two methods under which NCI can be measured are, number one, the fair value method, and the other one is the proportionate share of net assets. It is very important in your exam to identify in the question which method has the examiner provided. Because if the method is not clear, then you cannot do the accounting correctly. So first of all, let's see what fair value method means. The fair value method means that the measurement of NCI at the date of acquisition is done at fair value. In your exam questions, please keep this in mind that either the fair value will be provided directly by the examiner, or the other possibility is that the examiner will give you the per share price of the subsidiary company. So in that case, when we are talking about the subsidiary company per share price, it's very easy. You can take the subsidiary company per share price at the date of acquisition, multiply it with the number of shares that are being held by the non-controlling interest, number of shares precisely, and you multiply them and you will get the fair value of NCI at the date of acquisition. So you have to measure the fair value at the date of acquisition, and then that fair value is going to be used for the calculation of goodwill. And please remember that this is called full goodwill method, in which the NCI is calculated at fair value. When you use the full goodwill method, it means that the goodwill is not just of the parent company, it is also belonging to the NCI, and which ultimately means that later on, when impairment is going to be charged on that goodwill, in that also the share is going to be given to both the group and the NCI based on their percentage shareholding. So I'm going to take the example of 80% shareholding of the parent and 20% of the NCI throughout this topic explainer video. So over here also 80% is impairment is going to go to the group and 20% is going to go to NCI. On the other hand, if we are talking about the proportionate share of net assets method, in that case, when we are talking about the calculation of NCI, the measurement is done at the proportionate share of net assets at the date of acquisition. This means that we do not have the NCI value at the date of acquisition, the fair value. So what we do is that we calculate the fair value of net assets of subsidiary company, which we have to do as it is for the calculation of goodwill. And we would apply 20% to it to calculate the value of NCI. We do not know at what rate the NCI is there at the in the market. We are just calculating the fair value of the subsidiary company's net assets and apply the percentage. This ultimately means that above in the calculation also we have the same figure. Below, when we give the fair value of net assets in the calculation of goodwill, there also it's the same value. So the overall impact is nil. In such cases, the goodwill which is calculated is of the group only, of the parent company's share only. Okay, so this is a very major difference. And subsequently, when impairment is charged, in that case, goodwill is going to be charged to the parent shareholding only. In such cases, NCI is not going to have its share of impairment of goodwill. So please very clearly identify in your exam which method has been suggested by the examiner. Now, the next thing over here is, let's move to the next slide. This part I've already covered, that impairment is going to be charged to the parent's share only. Now, very importantly, when you're calculating NCI, the important thing is to identify that what is going to be the overall measurement criteria, the overall accounting. And it is very easy for you to understand if you keep in mind the base date is the date of acquisition. So you have to be very clear that some calculation is going to be done before the date of acquisition and some is going to be done after the date of acquisition. So exactly if we say before the date of acquisition, it's actually on the date of acquisition. So on the date of acquisition, you have to do certain accounting treatment related to NCI. And then after the date of acquisition also, you have to do some working related to this. I'll quickly go through this material and then I will show you a debrief question from the Study Hub also. As you know, Study Hub has the text material or the technical content knowledge related to your whole syllabus, and then they have very good debrief questions also within the text and in the practice platform as well, which you can attempt to clarify the concepts that we are discussing today. So, but let's first of all go through the concepts. So, accounting at the date of acquisition. First of all, you have to identify the value of NCI as per the measurement basis that we just discussed. So whether it's fair value model or it is a proportionate share of net assets, you have to identify that at the date of acquisition, a very critical date with respect to consolidation. And then you have to do the adjustment of it as a part of the goodwill calculation. So as we just discussed, whether you're going to take NCI at fair value or proportionate share of net assets, that's going to change your value of goodwill. Afterwards, when you are done with the valuation of NCI at the date of acquisition, then you have to calculate the value of NCI in the statement of financial position. It is a separate component of equity. So you have your share capital, share premium, which are of the parent company. Then you have consolidated retained earnings. Then comes the NCI portion. Then later on, I'll shift my video even down over here. So profit attributable to NCI in the statement of profit or loss and other comprehensive income. So we are also going to discuss later on that the value of NCI in the financial statements, you have to keep in mind which financial statement you're dealing with, and then you have to calculate the value of NCI accordingly. The rules are different for statement of financial position and the statement of profit or loss, although the logic behind them is exactly the same. We'll discuss shortly what I mean by that. So over here, I've included a diagram for your understanding as to how your accounting is going to look like. So over here also, you can see, first of all, the most critical date that is available, and that is the date of acquisition. So you identify the date of acquisition. All the working of the subsidiary company before and at the date of acquisition is called pre-acquisition working, and anything which is happening after the date of acquisition is called post-acquisition working. So when we talk about the impact of NCI before the date of acquisition, there is no adjustment that is required in the statement of profit or loss. So you can see over here that in the statement of profit or loss and other comprehensive income, there is no impact. While if we talk about the statement of financial position, it impacts the calculation of goodwill, just as we discussed. If we talk about the post-acquisition part, then in the statement of profit or loss, there is going to be a profit attributable to NCI. So it is our responsibility as financial reporting specialists that whenever the group finalizes its profit, we distribute it into two chunks. One that is attributable to the group and the other which is attributable to the NCI. Same is the case with the total comprehensive income. There is a line-by-line addition of income and expenses also which happens for the making of consolidated financial statements. We'll discuss this shortly again as well. And lastly, when we talk about the consolidated statement of financial position, then as we just discussed, NCI is going to be shown in equity at every reporting date. It's a very important part of equity because when we are talking about the group, so there's parent company, there is 80% share in subsidiary company, but the remaining 20% equity is belonging to the non-controlling interest. In case of statement of financial position, there is a line-by-line addition of assets and liabilities also. So now coming to the NCI accounting in the statement of financial position, the details of it. So here is a chart which is very comprehensive, covering almost all kinds of workings that are required. So just like we discussed in the last slide, first of all, we have to do a line-by-line addition of assets and liabilities of the parent company and the subsidiary company without thinking what the percentage holding of NCI is. So assets and liabilities, no impact at all. It is equity where we try to remember that only a certain percentage is held by the parent company or the group. The remaining belongs to NCI. And that is where in the equity, we recognize this NCI at the reporting date. So over here, if we talk about the calculation of NCI, it's very simple if we are using the fair value model. So that's very important that if we are using the fair value model, then in the NCI, the fair value at the date of acquisition is going to be identified first. Then later on, the NCI post-acquisition reserves are going to be taken up. This is very important that everything which was related to NCI till the date of acquisition, that's going to be there in the fair value. It already includes everything. Even the goodwill portion of NCI is already included in it. So we don't include it separately over here. We just take that as the base figure and then we build up on it. So the post-acquisition adjustments that we need to do, they are the share of post-acquisition reserves in the equity. So first of all, it is the post-acquisition retained earnings. Everything, remember, you have to multiply it with the percentage of NCI, because NCI, it's like for the group, we make separate pools of retained earnings, revaluation reserve, fair value adjustment, share capital, share premium. But in case of NCI, we put everything in one basket. So this is our basket, which is going to be represented in the consolidated statement of financial position. So we take up the post-acquisition retained earnings, the revaluation reserve, the other components of equity, fair value adjustment, and we multiply them all with the percentage of NCI. So we identify the share of NCI, and then this basket that we have created, we put all the balances in it. There are some other adjustments also. I'll discuss them shortly as well. So any other adjustments which are related to NCI, on them also we apply the percentage of holding of NCI, and we take the figure, and the total final figure is the NCI in the statement of financial position. This is the final figure which is shown in the consolidated statement of financial position related to NCI. Remember, if you're talking about individual company accounts, single company accounts, then any parent would just show their own share of investment in these single company accounts. So the concept of NCI only comes when we are talking about the consolidated financial statements. Then, if we are using the proportionate share of net assets method, then in that case, when we are talking about the NCI, here we have to make a little more effort because everything is not pooled into the fair value at the date of acquisition. So we have to practically give share of everything which is there in the equity related to subsidiary companies portion which is held by NCI and put it into this basket. So we take the share capital of the subsidiary company. Remember, this is only of the subsidiary company, share premium, because remember, NCI is only the portion in the subsidiary company. Parent is independent. So the parent company's shareholders have nothing to do with the NCI. Okay. So we take up the share capital, the share premium, pre-acquisition retained earnings, post-acquisition retained earnings, revaluation reserves, other components of equity, fair value adjustments, other adjustments, apply the percentage of NCI on them, and the final figure that we get is the NCI in the statement of financial position. So I've summarized the complete format for you in these two slides so that when you're solving the questions, you can very easily pick them up and solve them. Now, a few common adjustments which you need to do with respect to NCI. These are, we are going to pick them up. We are going to see what their impact on the related assets, liabilities, and equity are going to be, and then what is going to be their impact on NCI. I mentioned again, share of NCI. So everything, you just identify the share of NCI in it. So first of all, if we talk about the increase or decrease in depreciation on fair value adjustment, by now you must be already familiar with this, that there is fair value adjustment at the date of acquisition, and related to that, subsequently in the post-acquisition period, there may be an increase or decrease in the depreciation that we are charging. Then a similar kind of thing might be there for the amortization also. And then there may be any other fair value adjustment which is there in the post-acquisition profits. I'm going to move my video a little down because this is a very important area and I want the complete screen to be visible. So now if we see the impact on assets, liabilities, and equity, if there is additional depreciation, or there is a decrease in depreciation because there is a fair value loss at the date of acquisition, then we are going to pick that up and adjust it in assets or liabilities in one side. This is basically fair value adjustment is related to assets. So we are going to adjust the assets on one side. Similar case with the amortization. And if we are dealing with any other kind of liability, so maybe we're dealing with a particular provision, or we're dealing with a contingent liability which has been recognized, any deferred tax adjustment which needs to be done. So any such thing that has been identified that impacts our assets and liabilities directly. But anything which is related to the NCI in such case, we need to adjust it in the share of NCI also. So similar increase decreases are going to be shown in the NCI as well. And these are the items that you need to keep in mind for your further adjustments. Similarly, there are a few other adjustments also. I'm not going into the details of what these adjustments are because you must have covered these by now, which is why you've reached the NCI level. So where we have the impairment of goodwill, intra-group unrealized profits, and intra-group sale of non-current assets. So in case of impairment of goodwill, you decrease the value of goodwill. Let me just complete it full so that I can discuss both the NCI and the asset liability impact simultaneously. So in case of impairment, you decrease the value of goodwill and then you decrease the NCI also, because on one hand, the asset is decreasing. On the other hand, the value related to NCI is decreasing. So only with the portion of NCI. And remember, this will only happen in which model? Yes, the fair value model and what we call the full goodwill method. So intra-group unrealized profit, any unrealized profit that is there in the inventory at the year end and the sale was made by the subsidiary company, which means that the profit was included in the profit of the subsidiary company. So what we do is we decrease the inventory in the consolidated financial statements. The inventory is now with the parent company, but because we did a line-by-line addition, so we are going to decrease the inventory. And on the other hand, we are going to decrease the value of NCI also. Similarly, if you're talking about intra-group sale of non-current assets, then one company would have recognized the profit, the other company would have recognized the depreciation. So whether we are talking about the profit that has been there or the additional depreciation, we are going to adjust the asset for it, and simultaneous adjustment is going to be done to the NCI also. So please keep these adjustments in mind because these very frequently come up in your exams also. Now, this was all with the NCI accounting treatment with respect to the consolidated statement of financial position. Now we come to the consolidated statement of profit or loss and other comprehensive income. Now, in this case also, I've made this big grid, which if you pick up the question figures and you start putting them in here, your life is going to be much easier with respect to the working. So over here also, you have the profit or loss of the subsidiary company. So you start off with, remember, on one hand, there is a line-by-line addition of incomes and expenses starting from sales, cost of sales, admin, distribution, everything is being added on a line-by-line basis. So once you reach the profit after tax, technically speaking, parent company and subsidiary company's profit has been merged. At that point, we don't talk about any percentage of shareholding. When we say do a line-by-line addition, it is 100% figure of the sale of parent company and 100% figure of the subsidiary company if the subsidiary was held during the whole year. So a complete line-by-line addition has been done. But ultimately, the group only owns 80% of the subsidiary. So why should the consolidated statement have the complete profit? Which is why we do the consolidation working on one hand, and then we independently, separately have to do a working for the profit attributable to NCI. For that purpose, we pick up the subsidiary company's profit. Now, the next challenge comes over here. That in the subsidiary company's profit, we haven't made the adjustments. We did some adjustments while doing consolidation. We adjusted intra-group sales. We talked about additional depreciations, all of that. Now, that has been done in the consolidated statement, but not in the subsidiary company's profit. So we have to make this extra working where we pick up the subsidiary company's profit after tax and we start making the adjustments so that that profit and the profit which has been included in the group statements, it is the same. So we take up the profit or loss for the year for the subsidiary company. This is normally the profit after tax. We adjust the unrealized profit if the subsidiary company was the seller. If the company was using full goodwill method, we take up the goodwill impairment if there is any, then any additional depreciation on fair value adjustment, any profit on intra-group sale of non-current assets if the subsidiary was seller. If the parent company was seller and the subsidiary company had the assets, then there would be an adjustment of the additional depreciation. The subsidiary, if the non-current asset was sold at a profit, the subsidiary would be charging a higher depreciation. While now, when we consider that parent and subsidiary are not two separate entities, it is one big economic entity, then it's not possible that, like one department of the company maybe sends a non-current asset to the other department and charges a profit on it. So that's the profit that we need to eliminate, and we need to eliminate the additional depreciation also. So any adjustments that come in your questions, you have to make those. This is the adjusted profit, and now on that profit, you apply the percentage of NCI to calculate the profit attributable to NCI. Once you've calculated that, then the next working comes in, which is related to the total comprehensive income. You've already identified the profit after tax attributable to NCI. Now you take up the other comprehensive income of subsidiary company and may apply the percentage of NCI to it. The answer that you get is the total comprehensive income share of the NCI, what we call the total comprehensive income attributable to NCI. Now you are going to take up this figure, go back to the group profit that you've calculated through line by line addition and the adjustments. From that profit, you subtract the profit attributable to NCI. What's left behind is the profit attributable to group. There is no other shortcut way to identify the profit attributable to group and NCI, because after all the adjustments, a lot of things are intermingled. So this is the shortest possible way that we calculate the profit attributable to NCI, and then based on that, we calculate the profit attributable to the group also. I hope now the working is clear to you. In a case of the statement of financial position also, when we were dealing with non-controlling interest, we identified the similar things, we made the similar adjustments, and we found the equity part. Over here, we have to separately adjust the statement of profit or loss, because remember, in case of consolidated accounts, it's not like we calculate the profit and then we put it in equity. No, that's not the case. When consolidation happens, the consolidation working of statement of financial position is completely separate. It is done on working papers, and the consolidated statement of profit or loss is completely separate. So we can't assume that an adjustment that we've made in P&L would automatically be impacted in the statement of financial position. Now, a very important thing that you have to remember is that if the NCI was there partway through the year, so if the subsidiary was acquired or sold during the year, it means that it was at the status of subsidiary only for a particular number of months. So whatever the number of months were, the NCI calculation is also done only for those months. So if the subsidiary remained our subsidiary only for 4 months, we will do this complete working of subsidiary's profit and NCI share also only for 4 months. Now, the last part of it, we've seen how the working is done at the date of acquisition, how it is then accounted for post-acquisition in statement of profit or loss and statement of financial position. Now, let's see how NCI is treated at the date of disposal. For your financial reporting exam, only full disposal of subsidiary is tested. So first of all, while you are calculating the disposal value, you have to calculate the net assets and the value of subsidiary at the disposal date. The group profit or loss on disposal is calculated through this method. The individual holding is not calculated through this method. So once you have identified the NCI value at the date of disposal by giving all the shares of retained earnings, everything, you take up the sale proceeds, you subtract the net assets from it, the value of NCI and goodwill. And what you get now leftover amount is either the profit or loss on disposal. But do keep in mind, if the subsidiary was sold during the year, On the statement of financial position, there is not going to be any impact because the subsidiary was not the subsidiary at the year end. However, if it was a subsidiary for, let's suppose, 3 months during the year, and then it was sold off, we need to do the calculation of profit attributable to NCI for it. Now, this is all with the calculation of NCI. You have the syllabus reference also available over here. Please consult these learning outcomes so that you can have a good idea how the topics can be tested in your exam. Now, with respect to exam application, please do keep this in mind that this working can come up in any part of your exam. It can come up in section A as an OT, a 2-mark OT. Multiple times it has been tested. The data is given and the examiner says calculate the value of NCI. Same is the case with OT cases. And similarly, it can come up in the constructed response questions in the section C also, which is in 2 versions. Either it can come up while you're required to make a consolidated financial statement, be it a consolidated statement of financial position or consolidated statement of profit or loss, or it can come up in the interpretation of financial statements also, because in a lot of interpretation questions, consolidation is also tested. So NCI is going to impact over there also. Now, I will take you to the study hub to give you a quick look of the NCI calculations that I was mentioning. You can go through the study hub in detail on your own self also. So let's move to the study hub.
Here we are in the ACCA study hub to see how non-controlling interest is covered over here. You can see there is a separate heading for the non-controlling interest in the chapter number 22. On the left-hand side, you can see there is a lot of support available for this topic, including chapters, flashcards, quizzes, and practice. Over here, it is talking about what NCI is, how it is going to be accounted for at the date of acquisition as well as post-acquisition. So it is talking about the inclusion in the goodwill calculation at the date of acquisition as well as how post-acquisition it is going to be accounted for the consolidated working. You can see the working over here, NCI at acquisition, subsidiaries profits share since acquisition, subsidiaries OCI share since acquisition, and the consolidated statement of financial position figure is calculated. Important part, a very good example over here is that how the working for the calculation of goodwill varies if fair value method or the proportionate share of net assets method is used. There's a very good example over here. First of all, showing that if the NCI had a value of 28,000, a fair value of 28,000 at the date of acquisition, how will goodwill be calculated? So we had the cost of investment, we had the fair value of NCI, and then from this, it was subtracting the fair value of net assets of subsidiary company to calculate the goodwill. Now, the exact same question and the exact same figures are solved with the proportionate share method. Over here, the cost of investment remains the same, but the difference is that the fair value of NCI is not available. So how do we calculate the value to be allocated to NCI? We take the fair value of net assets of subsidiary company and apply the percentage of NCI to it. So 20% to it to get the value of NCI, and therefore you can see the value of goodwill changes. So it is very important in your questions also that you notice carefully which method for NCI calculation has been recommended. In most of the questions, it is fair value method in exam. However, the proportionate share method has also been tested in the past exam papers. You can also solve some other activities which are available over here to apply all the learning that we have covered.
Now, coming back to the presentation, just through the end of it, something that I always end with, please go through this concept in detail that I've discussed today. Do practice questions of it so that you are prepared for your final exam. Now, in here, just my last final words, focus a lot on practice, because that's the key to success. Because just listening to the video that has given you a complete concept of the topic, but now you need to see how that's going to be practically applied in different ways in your exam also. So do written practice, do it in a time managed way, and actively read the questions and the solutions to identify how the questions have been solved. The best thing is to first solve them yourself and then look at the solution. That's all from my side. I hope you found the video useful. Thank you so much for listening to it. And anything that you think you need to go back to, that's the advantage of a recorded video. You can go back, pause, listen to it, solve the questions alongside with those formats open. And I hope you'll find it very useful for the practical application. Thank you so much.